Good morning, students. Welcome back to the session on audit. So today we will continue with our discussion on LODR, that is about SEBI regulations. In the last session, we discussed various requirements of the LODR, and as we discussed that most of these points will require an understanding, but there are certain points in this chapter which you'll also have to remember. So that's why you'll have to just learn some of those points, particularly the one wherein the requirements were related to the number of meetings to be conducted, the number of directors which should be there on the board, and out of those directors, how many should be independent directors, how many should be the executive directors, how many should be the women directors. Otherwise, most of the requirements were something on which we can just have an understanding conceptually, and we can just think as to what is the real perspective behind bringing that provision, and accordingly we can just ensure that all of these things are taken care of. Now moving on to some more requirements, there are certain other disclosures which have been prescribed. So let's move on to that part now. The LODR regulations require disclosures of certain transactions. For example, the one which will take care of the transparency. Now, in case of a listed company, because the public is substantially interested, so that's why transparency is very important. And transparency would simply mean that the transactions which the company has been doing are something which can be made known to the users of the financial statements. And that doesn't mean that each and every transaction is required to be made known. It's about the significant transactions, some of the information which the public should know about that company in terms of making the decisions around the investment or around the stake that they will have in this company. So it's about bringing transparency towards that aspect. So let's understand what are these regulations requiring. The listed entity shall ensure timely and accurate disclosure on all material matters, including financial situation, performance, ownership, and the governance of listed entity in the following manner. First, information shall be prepared and disclosed in accordance with prescribed standards of accounting, financial, and non-financial disclosure. So this is one. And for example, we can say that the information which is required to be furnished to the stock exchange, or we can say to the public in terms of listed company, one of them could be the quarterly results, which are prepared as per the requirements of accounting standards for all of those listed companies, and for which audit or the review is also mandatorily required to be done every quarter. Next, channels for disseminating information should provide for equal, timely, and cost-efficient access to the relevant information by the users. Third, minutes of the meetings shall be maintained explicitly, recording dissenting opinions, if any. Now, another very important area is about the important decisions being made in the minutes, in the meetings of the board of directors, in the meetings of the audit committee, etc. Now, board of directors, audit committee, we can say they are those who are involved in the functioning of the organization. They are involved in the significant policy making for the organization. And that's why some of the things which are getting discussed, those are required to be properly documented in the form of minutes. And even if certain matters were discussed wherein there were certain dissenting opinions, so that should also be brought out clearly in terms of maintaining the information by all the listed companies. But when it comes to the matters, or when it comes to all of these requirements, it's not something which will come down to each and every point. Otherwise, it will become very, very problematic for recording or for maintenance of records of such information. It all comes down to the material matters, the significant matters, the one which are really relevant for anyone who is having stake in that organization. Moving further, and this is considered to be a very, very important disclosure for the listed companies, and this is not actually really limited to the listed companies. It also requires the unlisted companies are also required to take care of these disclosures related to the related party transactions or the related party balances. But currently we are talking about related party disclosures only in the context of listed entities. So let's understand what's the requirement, and we'll also try to understand as to how this is considered to be really important. The listed entity shall submit a quarterly compliance report on corporate governance in the format as specified by the board from time to time to the recognized stock exchange within 15 days from the close of the quarter. Okay. Now this is something which is very important, which is required to be submitted to the board. Details of all material transactions with the related parties shall be disclosed therein, and this shall be signed by either the compliance officer, which the company would be required to have, or the CEO of the company. So this responsibility of signing this document has also been placed on to the CEO of the company or the compliance officer. Now, compliance officer with a certain criteria is required to be appointed by certain companies. The company shall disclose the policy on dealing with related party transactions on its website, and a web link thereto shall be provided in the annual report. So now the policy, if the company has been maintaining in respect of dealing with the related party transactions, and which is required to be maintained by the listed companies. Now this will not only be given in the annual report, but this will also be displayed on the website of the company. The listed company shall disclose the transactions with any person or entity belonging to the promoter or the promoter group, which holds 10% or more shareholding in that company in the format which is prescribed by the relevant accounting standard. Now it's again requiring the disclosure in respect of related party transactions, and specifically this disclosure is required for the promoter or the promoter group, wherein that promoter group or the promoter is holding 10% or more of the shareholding. Why? Because stake of that promoter is involved significantly. So it has this really been ensured that the transactions have been taken at arm's length, or if the transactions have been taken at arm's length or not, irrespective of that, what's the quantum of those transactions? So all of these information is therefore required to be made available. Now, in respect of this information, another very important point which needs to be understood is that these transactions are taking place with the promoter or the promoter group. And that's why there is a possibility that these transactions may or may not take place at arm's length. Yeah, but this aspect has already been covered by us, because any of the transactions in relation to the dealing with the related parties are required to be pre-approved by the audit committee. The listed entity shall submit within 30 days from the date of publication of its standalone and consolidated financial results for the half year disclosure of related party transactions on a consolidated basis in the format which is prescribed for for the related party disclosure as per the requirements of accounting standards, and same should also be published on the website of the company. Now, this disclosure in relation to the in relation to the related party transactions or the related party balances is also required to be submitted to the stock exchange. Okay. Now let's come back to this requirement of related party disclosure. See, related party transactions are considered to be extremely important. As I have told you, whether it is about listed company or unlisted company, irrespective of the listing, such transactions are significantly monitored by almost every regulatory authority. And the primary reason for that happens to be the fact whether that transaction is taking place at arm's length or not. Secondly, what's the quantum of all of such related party transactions? So these two informations are very, very important for the stakeholders, for the users, for the regulators. And that's why every auditor is required to significantly spend time in relation to the audit procedures designed towards audit of the related party transactions as well as the related party balances. Now, when it comes to the related party balances or the transactions, auditor is not really having the responsibility towards ensuring that the transactions are taking place at arm's length, because this is something to a certain extent auditor can check, but beyond a point he will not be able to check as around the valuation which is involved. But by ensuring that the appropriate disclosures around all of these transactions have been made, auditor would be completing his duty, because he will be bringing out all of these transactions, or he will ensure that all of those transactions are made available in the financial statements or in the financial results or wherever these are required to be reported. And in respect of such transactions or the disclosures, the biggest concern for the auditor will be the completeness. Because if you look at the audit procedure or if you look at any of these disclosure requirements, whenever a related party is identified, so it's not difficult to capture its transactions. It's not difficult to capture the balances which the company will have with those related parties, because it's very easy to pull out that data from the accounting systems of the company, whatever systems they may be maintaining. Because if they know the names of the related parties, they will be able to do this very, very easily. The biggest challenge around this would arise in a situation wherein the names are not known, or it's difficult to assess the name, and that is where the completeness assertion arises. So I'm just using the audit procedure in this context because that again happens to be a very important part or a very important role during the audit. So that's why in relation to such disclosures which the management is also required to give, management also needs to take care that the completeness of all of these disclosures have been done. And that is only possible when the management will have a thorough understanding of all the related parties which it will have. Because some of the related parties, if those get missed, then automatically any transactions with them or any balances with them will also not get reported. Yeah, so the main aspect in relation to the related party disclosures is always about ensuring, first of all, that all the related parties have been identified. Because once that is done, the second part is generally considered to be easier. All right. Moving on to the next requirement. Disclosure of accounting treatment. Now, as around the disclosures of accounting treatment, wherein the preparation of financial statements treatment different from the one which is prescribed by accounting standard has been followed. The fact should be disclosed in the financial statements together with management's explanation as to why it believes such an alternative treatment is more representative of the true and fair view of the underlying business transaction. In this regard, auditor may refer to the relevant sections of the Companies Act which require that the financial statements or the financial results should be in line with accounting standards, which is about sections 133, 134, 143. And herein, the auditor should also refer to the compliance certificate. You remember the compliance certificate we discussed, wherein the CEO, CFO, etc. are required to take the responsibility in respect of the financial reporting. Now, this is something which you will find rare, because nowhere in the financial statements this non-compliance of accounting standard would be specified. Yeah, because the management would be very particular about it. So that's why all of these instances when the management believes that the treatment other than accounting standard has been followed, you will not find them. Very difficult for the management to take such positions. Next is in respect of the disclosures in relation to sexual harassment at workplace of women. Now, all of these matters are also required to be reported. So let's understand what does this disclosure require. If there have been any complaints which are filed during the year and the disposals thereof. So it's not only about the reporting of the complaints. So if the complaints were there, how many of those have been disposed of and how many are still pending as at the end of the financial year. So this once again is the disclosure which is required to be captured in the corporate governance section of the annual report. Next is about the report on the corporate governance. Every listed company shall submit a quarterly compliance report on corporate governance in the format which is prescribed by the board from time to time to stock exchange within 15 days from the close of the quarter. And this has to be signed by the compliance officer or the CEO, something which we discussed, right? The auditor should ascertain whether the board have included in the annual report a separate section on the corporate governance with a detailed compliance report on corporate governance. Any data in the report on corporate governance should not be inconsistent with the one which is given in the financial statement. So you remember the requirement of the annual report, the audit report. Now the auditor needs to ensure the consistency between the data which is moving anywhere in the annual report vis-a-vis the one which is moving into the financial statement. So that consistency check has to be ensured, of course, around all of these disclosures. Moving on to the next requirement, and that is about auditor's certificate. So let's understand what is this certificate. Every listed company shall obtain a compliance certificate from either the auditors or practicing company secretary regarding compliance of conditions of corporate governance and shall annex it to the director's report. So along with the director's report, a certificate around the compliances will be submitted. Depending on the facts and the circumstances, some such situations may require adverse or qualified statement or a disclosure without necessarily making it a subject matter of qualification in the auditor certificate in respect of compliances. As around the requirements of corporate governance. Let's see, for example. Now, what is this certificate and what are these non-compliances which are required to be reported? See, first, auditor is required to issue a certificate, and it can be a practicing company secretary also. Now, either the statement on which this certificate will be issued. Because when the certificate is issued, certificate will always be based on some management data. Yeah. Now, either that data may be materially misstated. We can say that there are big problems in that data on which the auditor may want to give some adverse comment or the qualified statement may want to give. But it's not necessary that it will always be qualified statement. Sometimes there could be certain situations wherein even though it's not a qualification, but still those non-compliances are reported there. So let's understand how will those be captured in the certificate. Number one, the number of non-executive directors which was required to be given or which was required to be in place is less than 50% of the strength of board of directors. Now, this was a mandate, but this was not fulfilled. So, this would be one of the examples of reporting in that certificate. Next, chairman of the audit committee, who should have been an independent director, was not the independent director in case of that company. So, this line will also appear. Audit committee did not meet 4 times in a year. Ideally, the audit committee meeting should have been at least 4 during the year, and with the time gap is not more than 120 days between 2 meetings, but it didn't take place. Yeah, so these are some of the examples of those known compliances which might have taken place, and these are required to be captured there. Okay, and these may not really become the qualification sort of. Now, what we can do is we can look at this pro forma certificate. Pro forma means the format as to how this is required to be captured therein, and we'll also see as to how all of these known compliances will be reported therein. So this will be issued to the members. So the certificate goes out to the members, then the name of the entity will come. Okay. Now, the auditor will start on this certificate saying that we have examined the compliance of conditions of corporate governance by XYZ Limited for the year ended, say, on 31st of March 2021 as stipulated in the SEBI listing LODR regulations 2015. Next. Now, what is it that the auditor has been doing? Auditor is first of all saying what the auditor has actually done. Now, similar to what the audit report will say, now the auditor will comment about the responsibility. So the auditor is saying the compliance of conditions of corporate governance is the responsibility of management. So it is clarifying that it is not my responsibility that the company complies with this. Our examination was limited to procedures and implementation thereof adopted by the company for ensuring the compliance of conditions of corporate governance. And of course, this is not an audit, and we are not expressing opinion on the financial statements of the company in this regard specifically. Now the auditor is coming to the opinion. So now the auditor says, in our opinion and to the best of our information and according to the explanations given to us, we certify that the company has complied with the conditions of corporate governance, or in case it has not been done, then the auditor will say, in our opinion and to the best of our information and according to the explanations given to us, subject to the following. Now, in this subject to the following, all of those non-compliances will be reported. We certify that the company has complied with the conditions of corporate governance as stipulated in the SEBI LODR regulations. Further, we state that such compliance is neither an assurance as to the future viability of the company, nor the efficiency nor the efficiency or effectiveness with which the management has conducted the affairs of the company. Okay, then of course the auditor will be required to sign it off, specifying the name of the firm, name of the member, membership number, place, date, and this being an attestation document. So this will also require UDIN to be placed on this. As I have told you that UDIN is now required to be placed on each and every attestation document, and this being an attestation document, so this will also require a UDIN to be mentioned. Okay, Sumit is asking, sir, the disclosure of the related party transactions under LODR and Companies Act C, not necessary. Yeah, the criteria are different, but if you talk about the nature of transactions, if you talk about the related parties, see, all of those things will remain same, because generally at both the places they will require you to comply with NPS. Though at certain places in the Companies Act, the definition of the related party has also been given, and which will be in addition to what is there as per the accounting standards. Okay. Harshad is saying, sir, for these conditions, means the conditions related to the corporate governance, if these are not satisfied, then the auditor will qualify certificate of compliance. See, again, this is judgmental. Auditor will have to assess what's the non-compliance, and in terms of the non-compliance, how significant is that? Because if the non-compliance is considered to be significant, then of course he will take a position. And generally what you will see is the moment there is a non-compliance, the auditor will include this line subject to, and subject to is nothing but in the nature of qualification only. Then Arshad is asking, so this compliance certificate just ensures that the company has complied with corporate governance or not? Yes, of course. So it's about a checking of this requirement of the LODR regulations for the company by the auditor. Even though this has already been captured by the company, the management, even though this has also been signed off by the compliance officer, and even though the board of directors would also be taking care of this, because it's eventually the responsibility of the board of directors to ensure all of such compliances. After that, so I'm saying even with all of these things in place, auditor will also be required to review this aspect. Okay. Okay, so now moving further, one of the items over here which is still pending for us to cover is about the resignation of statutory auditors from listed companies and their material subsidiaries. So let's understand this requirement. What is this requirement? And I think we'll have to just go to the relevant part. Okay, so now moving on to this next requirement around the resignation of the statutory auditors from the listed companies and their material subsidiaries. Now, if we look at the requirements, all the auditors are required to express their opinion as around the financial statements or the financial results, depending on whatever is the scope. But in the last couple of years, particularly, and I'm sure some of you who are also connected to this audit or all these if you are really involved in some of these discussions, you would have seen that in the past couple of years, with the stringent requirements coming into place as around the financial reporting, and the stringent requirements coming in respect of ensuring those compliances by the auditor, and also considering the fact that the auditor was also becoming subject of those auditor was also held responsible many a times in respect of certain non-compliances by the company. At various places, in respect of various companies, the resignations of the auditors started taking place, and these resignations actually increased significantly in the past couple of years. In respect of many listed companies, let's suppose if there were any problems in their financial reporting, which the auditor may have understood, so the auditors just immediately decided to resign instead of just reporting that matter in the audit report. What was really required on the part of the auditor was to ensure that all the transactions, all the results, all the financial statements which have been prepared are in line with the requirements of accounting standards. And if that has not been done, if there are any material misstatements, or if let's suppose the data which is required by the auditor is not in place, that has not been made available, then to report that appropriately in the auditor's report. So that's the duty of the auditor. But for some reason, it was understood that number of resignations because of the problems in the financial reporting, or supposedly because of the problems in the financial reporting, started taking place, and this got increased significantly. And just to ensure that such events or such of the things do not take place, some of these provisions were brought into the picture. And this was because of a couple of reasons. One, there's a duty which has been given to the auditor, and there's also a responsibility which has been placed on the auditor. And the auditor is given the responsibility to ensure that the financial reporting is as per the prescribed standards. And if that is not done, then to report. So what's the duty of the auditor? To report if the financial reporting is not in compliance with the relevant standards. Relevant standards means the accounting standards. Secondly, the duty of the auditor should be fulfilled by him. He can't just run away from this responsibility. He can't just say that because the management is not providing the data, because the financial reporting of the management is not really up to the mark, or which is significantly deviating from the required accounting standards, and which the management is not ready to correct, then he will just run away from this responsibility. He'll just resign and let the other auditors come and then complete the job, because that's not something which is expected out of the auditors. So they need to just stay there. They need to just make sure that each and everything has been audited by them, and accordingly they should report. And that is where this provision came into the picture. So this provision requires that the auditor should stick around. Even if the auditor would see some problems in relation to the entity, in relation to its financial reporting, the auditor needs to stick around and ensures that he is doing his duty. He should ensure that the responsibility which is assigned to him is taken care of by reporting on those matters, instead of just running away from that responsibility of being an auditor just by giving a resignation. This is also important because of the fact that for a company, and for a listed company, wherein the auditor resigns maybe towards the fag end when the financial reporting is due, or which is very close to the due dates as per the regulatory requirements, it may become very difficult for the management of that entity to ensure that the financial results or financial reporting is completed after getting the audits done on time. So let's understand this with the help of an example. So let's suppose the management has to report its results, say by, say this is 30th September, then by say 14th of November, the results have to go out. Okay, being a listed company. And because of the problems, let's suppose, which has been going on for some time, and which the auditor and the management, or say those charged with governance, have been discussing internally for certain matters, and which has not been resolved. Let's suppose auditor resigns sometime on say 1st of November. Now, to bring the new auditor on board and to get the audit of all of these financial results from the new auditor, would that really be possible for the management to complete that? No, it's not possible. It's not possible. So what will happen? Delays in financial reporting will start happening. Yeah. And these were some of the things which were observed. In many cases, just before the due dates, many a times, let's suppose if this is the due date, yeah, as per the requirements of again the SEBI regulations, the listed companies are required to report to stock exchange as to when they will report their financial results, 7 days in advance. So let's suppose in respect of 30th September, the company is planning to submit its results to the stock exchange on 1st of November, because this was announced and this was something which was communicated to stock exchange. And just before this date, let's suppose on 30th October, the auditor resigns, or this communication is made. So this will be a very problematic situation for the company, irrespective of the irregularities which they may have in respect of the financial reporting. But the auditor, if resigns, he's just running away from this responsibility, and this will also have a big impact on the confidence of the investors, on the confidence of the stakeholders. See, the stakeholders are interested in the company. They have placed their reliance on this company, considering the fact that all of these information which is made available to them is after review or audit by the auditors. Yeah, so that's why there's a huge responsibility on the auditors of the company. And with this context, this provision has been introduced, and let's now try to get into the details of this provision as to what this provision really requires. Audit committee has to make recommendations for appointment, remuneration, terms of appointment of the auditors. This is something we all understand, huh? We all know about it. Audit committee is responsible in a way for supervision of this entire process related to audit. SEBI regulations require detailed reasons to be disclosed by the listed entities to the stock exchanges in case of resignation of the auditor of a listed company as soon as possible, but not later than 24 hours of receipt of such reasons from the auditor. Why? Because this communication is very important, and this detailed reasoning is important to understand as to what was the reason because of which auditor wants to quit. Auditor cannot just quit for any reason. There has to be a genuine reason because of which he is quitting the company, and that should also be made known to the stock exchange. Then the regulations lay down certain disclosures to be made part of the notice to the shareholders for an AGM, where the statutory auditors are proposed to be appointed or reappointed, including the terms of their appointment. Now, in light of the above, the conditions to be complied upon the resignation of the statutory auditors of a listed company or its material subsidiary with respect to limited review or audit review are as given below. So let's understand now what are those requirements in relation to the resignation of the auditor. All listed companies or their material subsidiaries, while appointing or reappointing an auditor, shall ensure compliance with these provisions. First, if the auditor resigns within 45 days from the end of the quarter of the financial year, then the auditor, before such a resignation, issue limited review or the audit report for such quarter. So we can look at it over here. Okay, so let's understand this one. See, if we are talking about 2020-21, yeah. So first quarter is 30th June 2020. Second quarter is 30th September 2020. Third quarter is 31st December 2020. Fourth quarter is 31st March 2021. So we have got 4 quarters. Okay. Now we are saying if the auditor resigns within 45 days from the end of the quarter, then the auditor shall, before such a resignation, issue the limited review or the audit report for such quarter. So let's suppose for 30th June 2020, if the auditor resigns, means after the quarter is completed, then if he resigns within 45 days, so when is he resigning? Within 45 days of from the end of the quarter. So let's suppose 45 days from the end of the quarter is this. So 30th June, July, August. So 14th of August. If he is resigning somewhere over here. Now, why is this period put into place? Because the listed company is also required to submit its results after the end of the quarter and within 45 days from the end of the quarter. So we are saying that after the quarter has ended and now the auditor wants to resign. So he should ensure that this quarter he will audit, he will review, he will have to submit the report. So that's why this responsibility has been attached from which he cannot run away. He will have to issue the report. Otherwise, he will not be able to resign. Requirement number 2. If the auditor resigns after 45 days from the end of the quarter, means somewhere over here, then the auditor shall, before such resignation, issue the limited review or the audit report for such quarter as well as the next quarter. Okay, so let's understand. If the auditor is resigning after 45 days from the end of the quarter, so after 45 days means over here, auditor is resigning. Then the auditor would have issued, if after 45 days he is resigning, auditor must have already issued the report for this quarter. Correct? Yeah. He would have issued the report for this quarter. then the auditor shall, before such resignation, issue the limited review or the audit report for such quarter as well as the next quarter. So that means for the next quarter, he will have to issue the report. Okay. His resignation will be accepted provided that the next quarter is again the one on which he will report. Requirement number 3. If the auditor has signed the limited review report or the audit report for the first 3 quarters. So which are these first 3 quarters? These. If for these 3 quarters, auditor has issued the report, means he has signed. Then the auditor shall, before such resignation. Now let's suppose he has issued the report. Okay. For 3 quarters of the financial year. Now let's suppose auditor wants to resign. So now auditor wants to resign. So that means he doesn't want to issue the audit report for this financial year 2020-21. Now, what is required on the part of the auditor? Then the auditor shall, before such resignation, issue the limited review or the audit report for the last quarter of such financial year as well as the audit report for such financial year. So that means if 3 quarters have been covered by him, then he will have to complete the 4th quarter also. Now, for the 4th quarter, he cannot just say that I will not complete the audit. He will have to do this. Harshad is asking, sir, can the audit committee reject the resignation of the auditor as a whole? I didn't understand this word as a whole, but these are the provisions which are coming from the SEBI regulations. Okay. And that's why it's not about rejecting the resignation by the audit committee. If you are talking about these 3 requirements that we have discussed, it's about not allowing the auditor. So auditor is not allowed by law to resign in this case. Okay. So there are some other conditions in relation to resignation. Let's understand those conditions also one by one. First, reporting of the concerns with respect to listed company or its material subsidiary to the audit committee. Now let's also try to go back to our discussion and try to understand the perspective. See, what's the perspective? Why did this provision get introduced? This provision got introduced because wherever there was some problem and which was not within the control of the auditor, means the management was not really agreeing to the view of the auditor. So what was the soft stand which was taken by the auditor? Just to resign. Very simply to resign and move out. Which may be very, very easy on the part of the auditor, but for the investors, for the stakeholders, it was becoming increasingly difficult because they were losing their confidence. And this was impacting the financial reporting of all of those companies and the investor confidence significantly. That is where all of these provisions have been brought in, that if the auditor is feeling any concern, if the auditor has got any concerns, then he has to discuss and report. He cannot just simply run away. Harshad is asking, what is limited review? See, limited review, we can say, is again a kind of attestation for the quarterly results which are issued by the, or which are required to be submitted to the stock exchange by the listed companies. Instead of getting an audit done for that quarter, they can get this review done. Review, you can say, is a diluted form of audit. Okay. Reporting of concerns with respect to the listed entity or its material subsidiary to the audit committee. In case of any concern with the management of the listed company or material subsidiary, such as non-availability of information, which would have been the big problem on the part of the auditor. Non-cooperation by the management. The management is not cooperating, because of which auditor is not able to complete the audit. The auditor shall approach the chairman of the audit committee of the listed company, and the audit committee shall receive such concern directly and immediately without specifically waiting for the quarterly audit committee meetings. As we have discussed that every quarter audit committee would have meeting with the auditor in relation to discussions of the financial results and the audit procedures and various reportings around it. Now, in this respect, when there are concerns which the auditor wants to highlight, so the chairman of the audit committee will have to have this audit committee meeting necessarily to understand the concerns of the auditor. If the auditor proposes to resign, all concerns with respect to proposed resignation along with the relevant documents shall be brought to the notice of the audit committee. If the proposed resignation is due to non-receipt of information, the auditor shall inform the audit committee about the details which he has been asking from the management and the management has not been able to provide, or the management is not ready to provide. On receipt of such information from the auditor, the audit committee or the board of directors shall deliberate on the matter and communicate its views to the management and the auditor. Okay. Next, disclaimer in case of no receipt of information in accordance with auditing standards. So let's understand what's the next requirement. The listed company or its material subsidiary shall ensure the conditions mentioned in A and B above are included in the terms of appointment of the statutory auditor. What is this A and B above? A and B is about that the auditor cannot resign, say, without completing the audit of this quarter, if he is resigning over here, without completing the audit of next quarter, if he is resigning over here, without completing the audit of full financial year, if he has completed the audit of 3 financial years, three quarters, or ensuring that he communicates with the audit committee or the board of directors, whatever the case, in case he is finding any concerns, instead of just placing reliance, instead of just placing resignation and moving out. Yeah. So now this will have to be included in the engagement letter of the auditor. So when the auditor will get appointed, in terms of appointment of the statutory auditor, all of these things will be specified. So this will form part of the engagement letter. And in case the auditor is already appointed, because nowadays auditors are in appointment for 5 years, then the suitable modification should be included in respect of these clauses in the engagement letter. The practicing company secretary shall certify compliance by a listed company on the above in the prescribed annual secretarial report. Okay. This responsibility has been placed on the company secretary also. What's the third requirement? Obligations of the listed company and its material subsidiary. Format of information to be obtained from the statutory auditor upon resignation. Cooperation by the listed company and its material subsidiary, and the disclosures of audit committee's views to the stock exchanges. So if you understand all of these provisions, what's the real idea behind this? See, there are a couple of things which you can make out. First, of course, is to ensure that the auditor is able to fulfill his responsibility. Auditor is able to perform his duty by ensuring that the audit committee gets involved and helps the auditor in resolution of the problems which he has been facing. So it's about improving the coordination between the audit committee and the auditor, because it's the audit committee who has been supporting the auditor, or who has this entire responsibility in relation to the audit process. Secondly, when all of these communications are made to the stock exchanges, etc., so a transparency has been brought in terms of this problem which may have been faced or which may have taken place inside the organization, so that the relevant authorities also get to know as to what was the reason which forced the auditor to move out, or which is forcing the auditor because of which he's planning to move out. Yeah, and these are some of the areas, as I've discussed with you, are really being focused upon in the current environment. In the last couple of years, there was significant increase in the number of resignations by the auditors of the listed companies as well as the unlisted companies, and because of which this provision became very, very important to be introduced. And nowadays, even if we talk about this unlisted company, and let's suppose if the auditor plans to resign from the unlisted company, it's not accepted as it is, because the auditors are also required to place their resignation on the or to the ROC, on the MCA. Yeah, that's the Ministry of Corporate Affairs. So there again, the auditors are required to give the reasons, and which may be rejected at times. So we have seen instances wherein the resignations have been rejected because the reasons for the resignations were not considered appropriate. Yeah, clear? Okay, so with this, we come to an end to our discussion on the LODR regulations. And in case you have any questions, queries around this, we can have a discussion on that before we move on to the next chapter. So I'm hoping, Harshad, you are clear on this now. Okay, any more questions, doubts from your side? Okay, so we'll move on to the next topic now. No, these are in relation to the statutory orders, Harshada. Okay, moving on to the next topic, that is about audit of NBFCs. Okay. Now, what is an NBFC to start with? Because when it comes to the audit of NBFC, it's not going to be the same thing like we discussed in case of any other company. NBFC means non-banking financial company. And the nature of business of these companies or the entities is significantly different from what we see in case of other companies. And because of the nature of the business of these companies, which is significantly from other companies. That's why a lot of provisions which may be coming out from the regulatory requirements, a lot of procedures related to the audit, and the reporting requirements in relation to any of the requirements related to law, be it financial reporting or be it reporting under any other area which NBFCs are required to do, will be significantly different. So what's the business of NBFC? In simple terms, we'll also get into the details of the meaning of NBFC. In simple terms, we can say that NBFCs are supporting the banks, or you can say they are also playing to a certain extent the role which the banks are playing. But it's not exactly similar to banks. It's not exactly similar to all the functions which are played by the banks today. There are also certain striking differences between banks and NBFCs. So let's try to understand what are the roles being played by NBFCs. When it comes to taking a loan, okay, let's suppose if we need a loan today, what do? We will think of a bank and we'll approach the bank for this loan. Yeah. But in certain cases, the banks may not provide the loan because of certain requirements which are placed on the bank. Now, similar to this, if we require any funding, we can also approach the NBFC. The provisions in respect of advancement of that loan by the NBFC to any other entity is not as stringent, which is the case for a bank. Those are slightly diluted. Those are slightly diluted means in terms of various compliances which that entity would be required to fulfill to get the fund from the bank may not be same and may not be as stringent as would be there in case of a bank. That's why it becomes relatively easier. It's not easy, I'm saying relatively easier for an entity or for a person to take such fund from an NBFC. And I would say this is primarily the role of an NBFC to give funds, to advance money. And same is the case of banks also. Banks are also there to advance money. So we can say that the nature of the business of the NBFC therefore is what? To advance money, to lend money. And for this purpose, NBFCs would also need funds. Yeah. So what is therefore the business of the NBFC? To obtain funds and to advance funds. That is how NBFCs operate. But as I told you, they do not operate similar to the way banks operate today. Okay. There are differences between these two. So let's now understand the definition of an NBFC. So what's the definition of NBFC? Definition of NBFC defines it as a financial institution, which is a company, a non-banking institution, which is a company, a non-banking institution, which is a company, and which has its principal business of receiving the deposits or lending in any manner or such other non-banking institution or class of such institutions as the bank may be with the previous approval of central government. We can say there's a test which the NBFCs are required to fulfill, or you can say in respect of the business of an entity, if we perform this test and if this criteria, you can say in other words, is met, then such an entity will be considered to be an NBFC. So let's understand what's the criteria which we need to look through. This is at times also called as 50-50 test. So let's understand. We need to pick up at one place total assets of the NBFC and at the other place gross income of the NBFC. Okay. Now, if the financial activities of an NBFC generate financial assets, means the assets which are generated from these activities. These activities means the activities which I just specified, means they are taking money and they are advancing money. So this is called as financing activity, or you can say financial activity. If let's suppose through this activity, they generate certain assets, okay, which I am calling as financial assets. Okay, and through this activity, this entity will also be generating some income, which I am calling as, say, finance income. Okay. Now, if the financial assets are more than 50% of the total assets, and if this income which is generated from financial activity is more than 50% of the gross income, then the principal business of such an entity will be considered to be that of an NBFC. And in such a case, such an entity will be considered as an NBFC. And both these criteria are required to be fulfilled. And because of this one as well as this one. If both these criteria are fulfilled, then this entity will become NBFC in relation to the business it is conducted. So we are not saying that just by doing such business or just by fulfilling this criteria, you can also look at the board. So we cannot say that just by fulfilling this criteria, this entity will become NBFC. No, there are some more requirements for such an entity to become NBFC. But as far as its business is concerned, it will be considered as if this entity is carrying out the business of that of an NBFC. And therefore, this entity should get itself registered as NBFC. Okay, clear on this? Now moving on to the regulatory requirements. Certain regulations in relation to NBFC. Considering the fact that the public interest is significant in case of NBFC, and why? Because we can see the nature of the business of NBFC, or we can say the principal business of the NBFC, that is what? To advance money, to obtain funds. And that's why this is one of the entities in which public interest is involved very significantly. And considering this fact, NBFCs are highly regulated. NBFCs are also subject to various regulations. And some of those regulations happen to be the one which are driven by RBI. Okay, so the RBI Act covers the NBFCs in terms of various provisions related to them. And this act has also got amended quite a lot. So that's why you can see this RBI Amendment Act or so and so. But basically, it was all about RBI Act, which drives the provisions related to NBFCs. So let's understand what's the requirement in relation to an NBFC. No NBFC is allowed to commence or carry on the business of an NBFC without obtaining certificate of registration issued by Reserve Bank of India and without having a net on fund of rupees 25 lakhs, not exceeding rupees 2 crore, as the RBI may by notification in the official gazette specify. So there are two mandatory things. One is to obtain certificate of registration from RBI. So if an entity is doing the business of NBFC but has not obtained certificate of registration from RBI, then it is not an approved NBFC and that business will be considered to be illegal. Number two, for an NBFC to obtain this registration and to get registered, it should have a minimum net on fund. What is this net on fund? You can say it's the capital of the NBFC, which is known by this name. Net on funds means the capital. It's the core capital of the NBFC. Okay, clear on this? Now moving further, let's move on to the requirements related to the types of NBFCs. Now, if you look at NBFCs, those are not the one which we'll see or the provisions in case of NBFCs, the nature of the NBFCs will not be the one which you'll see in case of any other entity. Yeah. So that's why what we are currently doing is we are trying to get an understanding about NBFCs, the way they operate, the way they are required to be registered, the way they are regulated, what are various provisions related to NBFCs. Once we are through with some of these parts, then we'll get on to the audit procedures around all of these things in relation to NBFCs. Okay. So the next thing that we need to understand is about the regulation in relation to NBFCs. NBFCs, as we have understood, are required to be mandatorily registered with RBI, Reserve Bank of India, and they need to have some minimum net on funds. In relation to NBFCs, there are certain directions which have been issued. Now, what are those directions? You can again say these are certain regulations which have been issued. And considering those regulations, various provisions related to NBFCs have been defined. Means how should they be registered, what will be the categories of the NBFCs, how those NBFCs will operate, what is the requirement in relation to the NBFCs in respect of keeping certain ratios, in respect of keeping certain assets, in respect of keeping certain liabilities, in respect of keeping certain reserves. So there are a lot of provisions, and all of those provisions are driven by various directions. So the word directions has been used. You can just simply understand that direction is nothing but a regulation in relation to an NBFC. Now, NBFCs, on the basis of those directions, can be categorized broadly into three categories. Okay. Now, if I have to look at those directions, we can say NBFCs can be broadly categorized into three categories. One, that is deposit taking NBFCs, and second, which is non-deposit taking NBFCs. Number two, as around non-deposit taking NBFCs, by their size, they can further be categorized into two categories: systemically important and non-systemically important. Let's understand how do we do this. As I have told you, on the basis of directions. And these directions have also been issued by RBI. This is how we can categorize them. Deposit taking NBFCs and non-deposit taking NBFCs. And then in respect of this non-deposit taking NBFCs, the one could be related to systemically important, other one is non-systemically important. See, whenever it is non-deposit taking, it is termed as ND. Okay. Now, when it is systemically important or non-systemically important, then the term will be SI or NSI. SI will be for systemically important and NSI will be for non-systemically important. And for the time being, don't get confused as to what is this systemically, what is this deposit taking, what is this non-deposit taking. We will discuss various provisions on the basis of which you will be able to make out what is the relevance of these directions and what is actually the difference between these systemically or non-systemically, deposit taking or non-deposit taking. For the time being, you can say that this is one of the criteria which have been picked up to segregate various types of entities into certain categories. Okay, so some NBFCs have been put under this bucket. Some NBFCs have been put under this bucket. Some NBFCs have been put under this bucket. And for all of these buckets, the regulations are different. Not entirely different, but the regulations happen to be different. That's why separate directions have been issued for these type of NBFCs, for these type of NBFCs, and for these type of NBFCs. Okay, clear on this? Third, so we can say, of course, 1 and 2 is this deposit taking and non-deposit taking. Then on the basis of the activities of the NBFC, they can be categorized. And let's understand what can be those categories of NBFCs on the basis of the activity which they do. So let's move on to presentation once again to understand the activities. So you can see some types of NBFCs over here. Investment and credit company, infrastructure finance company, systemically important core investment company, infrastructure debt fund, NBFC. Then we have microfinance institution. Then we have NBFC factors. Then we have NBFC non-cooperative financial holding company. Now these are various technical terms and we don't need to get into all of these technicalities. That is not really required to be understood in so much detail. Sumit is asking me the same question, sir, what is this systemically or non-systemically? Oh, so he's asking, is it systematically or systemically? It's systemically. So this spelling is absolutely correct. Huh? So don't get confused. So this is the term which they have used, and as I've told you, this is again on the basis of the size, etc., which this segregation requires. Okay. There are certain NBFCs which are exempted from the requirement of registration with RBI. Why? Because of the fact that some other regulation is driving them. Means other than RBI, they are required to get registered with some other organization. For example, stock exchanges. They are driven by SEBI regulations. For example, housing finance institutions. They are regulated by National Housing Bank. For example, merchant banking companies, they are again regulated by SEBI requirements. For example, venture capital fund companies, they are again regulated by SEBI. Yeah. So these are some of the entities which are again NBFCs. But being an NBFC, they are not really required to be driven as per the requirements of RBI. No, instead some other regulation is driving them. That's why those have been exempt from registration with RBI. Okay. Similarly, we can have many other companies, microfinance companies, insurance companies, because those are regulated by IRDA, Nidhi companies, those are regulated by MCA, chit companies, because there's a Chit Funds Act which is regulating them. So there are a whole lot of companies like this and which are exempt. Now, as around the NBFCs, these were some of the provisions in relation to their segregation that we have discussed. Means how they can be segregated. Now we will move back to the understanding of NBFC and will also try to correlate some of the requirements of the NBFCs with the banks and the differences between the NBFCs and the banks. So currently on the slide, some of the differences that you see we'll discuss, and there is one more difference which is not currently appearing on the slide and which we'll discuss. If you want, you can also keep referring to the study material alongside. NBFCs cannot accept demand deposits, which the banks can do. However, NBFCs can accept term deposits in some cases. Okay, but as far as demand deposits are concerned, those cannot be accepted by the NBFCs. So this is one of the differences between them. NBFCs do not form part of payment and settlement system and cannot issue checks. They cannot issue checks which are drawn on itself, which the banks can do, NBFCs cannot do. Third, deposit insurance facility of DICGC is not available to depositors of NBFCs, but that is available in case of banks. Fourth, there is no minimum exposure to priority sector. So the banks are required to have some minimum exposure to priority sector. Okay, those priority sectors have again been prescribed as per the required regulations, wherein they are required to have some minimum exposure, but that is not the case in case of NBFCs. Okay, clear? So far, some of these things that we have discussed was all about the categorization of NBFCs, the meaning of NBFCs, and how those were different from the requirements in relation to banks. Now moving on to the prudential norms. So what are the prudential norms? See, in terms of the prudential norms, every NBFC, and this is similar to the banks, every NBFC is required to maintain certain capital level. Capital means the capital of the NBFC, and which we also termed as net on fund. You remember? So the NBFCs are required to maintain a certain threshold level in terms of the capital it will have. And that has been prescribed as not less than 15% of its aggregate risk-weighted assets. So let's understand this concept. What do we mean by risk-weighted assets and what is this capital requirement? So this is the capital of the NBFC. Say it is 20. Okay, 20 crore. And there are certain assets of the NBFC. Because like any other entity, NBFC will also have some assets. Yeah. Now, in simple terms, we can say, if let's suppose assets of the NBFC are 100 crore, we are trying to check what is the percentage of the capital in terms of its coverage against assets, or what is the proportion of the capital in relation to the assets of the NBFC. If we have to check that, then what do we say? We'll say that it's 20% right now. Yeah. So that means 20% of the assets is what the capital of the NBFC is right now. Because other than capital, there could be a whole lot of funds which the NBFC would have also obtained. But this is required to be kept at a certain threshold, which is minimum. Below this, it cannot go. Otherwise, it will be a non-compliance of the regulation. Now, in relation to this, when we look at the assets of the NBFC, the assets in terms of their value are not required to be picked up as it is. As it is means they cannot be just picked up at the book values, the way they will be appearing in the financial statements of the NBFC. So there's a criteria for picking up the value of the assets. Let's understand what is this criteria. See, if we have an asset of an NBFC, against every asset of an NBFC, certain risk percentage will have to be specified. Risk percentage. Let's understand by taking some examples. Let's suppose NBFC has got an asset in the nature of cash and bank balances and certificate of deposits with banks. Cash and bank balances and certificate of deposits with banks. So this is an asset of NBFC. Sorry for this alignment problem. Next, NBFC has got some investments. One. Number two, NBFC, let's suppose, has got investments in approved securities. Approved means approved as per the regulatory requirements. NBFC has got investments in approved securities. Okay. Number three, NBFC has got investments in bonds of public sector banks. These are only examples. So I would say this is only an example that I have been discussing with you. Only an example. Investments in bonds of public sector banks. Number four, investments in shares of all companies. So you can say investments in shares of companies. Number four. Number five. Number five we can say is the fixed assets which the NBFCs hold. NBFC will also have building, furniture, fixture, office equipment. What are those? Fixed assets of the NBFC. Okay. Now, as around all of these assets, certain norms have been prescribed. Norms for assigning the risk which is attached to each asset. When it comes to cash and bank balances, which are maintained with banks. So NBFC may also have a bank balance. NBFC may also have a fixed deposit with any other bank. Now, in relation to this, it is assessed. And who assesses this? The regulatory authorities. You can say RBI, for example. RBI assesses that in relation to such type of asset of any NBFC, I'm not saying any specific NBFC, of any NBFC, what would be the risk? RBI has assessed, or we can say currently this risk has been assessed to be 0%. Means if the asset is in the nature of this, then there is no risk in that asset. Similarly, if the NBFC has invested in securities which are approved by the regulatory authority, those have again considered to be risk-free. So the risk weight, this is what? This is a risk weight which has been attached to this particular asset is 0. Okay. Now, when this investment shifts to bonds of public sector banks, now the investment is not in an approved security. It's a security. What's the security? Bond. But that is of public sector banks and the nature of security has changed. Then the regulatory authorities believe that it's not risk-free the way these securities were or the way this asset was. And they have assigned a risk of 20% to this. Okay, they have assigned a risk of 20% towards this. Okay. When it comes to shares of companies, so the norm says, the regulation says it's completely risky. So there is risk involved in this. It's 100%. It cannot be considered to be safe. Similarly, when it comes to the fixed assets, the risk weight which is attached is again 100. Okay. Yeah. Now, what's the relevance of this? Let's understand the relevance of this. Let's suppose if we look at the amount or the value at which all of these assets have been appearing in the financial statement. Let's suppose this amount is 100 crore. Let's suppose this is 50 crore. Let's suppose this is again 100 crore. Let's suppose this is again 50 crore. And let's suppose these are 150 crore. Okay. Now, what is required to be done? The value of the assets is required to be obtained after attaching the weight of the risk to them. And that is what will be called as risk weighted assets arrangement. Means wherein the weight of the risk has been attached. And if we attach the risk, then what's the amount that we'll get? It will be 0. It will be 0. This will be 20%. So this becomes 20 crore. This becomes 50 crore. This becomes 150 crore. So all in all, we will get 220 crore as the value of the risk-weighted assets. Understood the meaning of risk-weighted assets? Now the criteria says that when it comes to the capital of NBFC, the capital of NBFC should be minimum 15% of this risk-weighted assets. So whatever be the value of these risk-weighted assets, a certain proportion, which is currently 15%, should be maintained by the NBFC in the form of their capital. If that goes below, then they will have to ensure that they reach at least minimum 15%. Okay. Clear on this regulation? Clear on this criteria? Sumit is asking, sir, on which criteria these weights are assigned? See, these are assessed by the regulatory authorities. Various factors around the economy go behind this assessment of risk weight. Sumit is saying if an NBFC is a scheduled commercial bank under RBI, then it will be NBFC or it is converted into bank. See, it's not that it's a bank and that's why it will be converted into a bank. For becoming a bank, it will require separate requirements to be fulfilled. Only then it will become a bank. And otherwise, you cannot say that it's a bank and that's why it's required to become a bank. No. And as we have discussed, that banks have got certain set of activities which NBFCs cannot do. And the same problem will arise in this case also. Okay. Yeah. So before we move further on to NBFCs, we'll pick up a very important criteria around NBFCs, and that will be around the categorization of their advances or we can say the primary assets and the provisioning norms, and which is very, very interesting also. But before that, we can take a break, and any of your questions, you can just let me know. Harshad is saying, sir, that is 15% of 220. Yes, of course. So you can say, currently the NBFC shall maintain minimum capital ratio. I'm just reading this from the study material only. Currently, they are required to maintain minimum capital ratio consisting of tier 1 and tier 2, which shall not be less than 15% of its aggregate risk weighted assets on the balance sheet and of risk adjusted value of balance sheet items. Yeah. So there are certain off balance sheet items which are also required to be captured. And the same thing you will see in case of banks also. But the percentage will be different. The risk weights will be different. Okay. Clear on this? Okay. Harshad is saying NBFC, sir, or NBFC minimum requirement of NOF is, it's 2 crore. It's 2 crore. It's not 2 lakhs, huh? It's 2 crore. That's the minimum requirement. Okay. All right. So we can now take a break. So let's take a break of 10 minutes. And after the break, we will continue our discussion. Hi. So let's move on to the next requirement of NBFCs. Very important one, and I would say quite interesting to understand. And most of you would be knowing about it already. This is in respect of income recognition. And with this, the principle of non-performing asset and the income recognition as around non-performing asset is also linked. So let's understand the requirement. It says the income recognition shall be based on recognized accounting principles. Income including interest, discount, or any other sort of income on NPA shall be recognized only when it is realized. Any other income before an asset becomes NPA shall be recognized on an accrual basis, and any income in respect of an NPA which has been recognized but which is unrealized will have to be reversed. And then we'll move on to some of the requirements related to classification of assets. So let's understand these principles. See, for an NBFC, we can say its assets, its advances may be categorized into following categories. First, standard assets. Second, substandard assets. Third, doubtful assets. Fourth is about loss assets. So these are the four categories which can be created in respect of assets of NBFC from the perspective of looking at this provision related to provisioning. Now, if we look at the standard assets, what are these standard assets? We will get into the technical assessment of all of these assets one by one. In simple terms, we can say when an advance has been given by the NBFC and that advance is performing well, means the customer to whom such advance is given, that customer is making the repayments of principal as well as interest on time. Means everything is good in respect of such asset in terms of its recovery. There's no default so far. There's no delay so far. And such type of assets are called as standard assets, means assets which are good. However, considering the nature of the business which the NBFCs have, they are required to lend money, they are required to advance money, and it is very much possible and it is very frequent that the repayments of those monies are either delayed or even defaulted, or you can say significant defaulted by the customers. So we can say the asset will not be always good at every time. For each and every customer, the asset cannot be considered to be good always. It may also become bad. And that's where the regulations bring in the categories, or you can say the stages of an asset becoming bad. All of these stages reflect that there is a question mark in relation to recovery of the monies which have been advanced by the NBFCs. So first category, when the asset could become bad, is considered to be substandard. Then after substandard, if it becomes worse, then it is called as doubtful. After doubtful, when it becomes worst, it's called as loss asset. All of these three categories indicate that the asset is not performing. So this asset is what we call as performing. Performing means the repayments, etc., everything is on time. So this asset is performing. Okay. But these three categories are what? Under these three categories, asset has stopped its good performance. Or in other words, we can say the asset has become NPA. Okay. Now, if you look at the income recognition of an NBFC, we are saying that let's suppose this asset is what? This asset is a loan given by an NBFC to a customer of NBFC. Okay. Now on this loan, NBFC will be receiving two things. One, the principal, and second will be the interest portion. And this interest is what? Interest is the income of NBFC. Now, as regards the income recognition criteria, the regulations say that if the asset is tendered, then the income, that means the interest income or whatever be the kind of that income, should be recognized on accrual basis. Income will be recognized on accrual basis. Why? Because its collection is not uncertain. It's collectible. But the moment an asset has become bad and it is becoming worse, there's a question mark in relation to recovery of the principal. Forget the interest, forget the income. We are not even sure whether we will be able to recover the principal. So what is the point of recognizing interest income on that case? Will it be appropriate to recognize interest when there's a question mark as around the recovery of the principal? The answer is no. But an asset will not straight away jump onto substandard category. An asset will not straight away jump onto doubtful category. It will take some time to become bad. And that is again as per the requirements of the regulations. And during this period, maybe when the asset was tendered, or maybe this time frame which took an asset to become substandard from standard, some income may have been recognized on accrual basis. Yeah, some income may have been recognized on these assets on accrual basis. What do we do with that income? Because that income is not yet received. That interest is accrued but not yet received. So this regulations say that if there is any accrued income, that should be reversed. That should be reversed. And any further income including this reversed income should be recognized only when realized. That will be recognized only when it is received, only when it is realized. Realized means it is received. Okay, because if it is not received, if it is not realized, then the income should not be recognized. Clear? Clear on the criteria of income recognition? Please remember that as an auditor, we are also required to ensure all of these regulations are in place. All of these criteria are getting fulfilled. And that's why, as an auditor, for any procedure to be performed in respect of all of these requirements, it's very, very important that the requirements are thoroughly understood. Only then the auditor will be able to perform any of these procedures, otherwise not. Okay. So now what we will do is, now we will get into a detailed understanding of all of these categories of assets. Okay. So moving on to the first one. Moving on to the first one, that is standard asset. What is the standard asset? It shall mean the asset in respect of which no default in repayment of principal or interest is perceived and which does not disclose any problem or carry more than normal risk attached to the business. Yeah. So that means it's completely risk-free as of now. Moving on to the second category, substandard. So when would an asset become substandard? An asset which has been classified as non-performing asset for a period not exceeding 18 months. Now this part is very important for all of you. For an asset to be called as substandard, it should become non-performing for a period of not exceeding 18 months. So non-performing for not less than 18 months. Okay, so we can say greater than or equal to 18 months. In case of NBFCs, which are systemically important non-deposit taking, and this period of 18 months shall be 12 months, where the NBFCs are systemically important non-deposit taking and deposit taking. So this criteria is for whom? Non-systemically important non-deposit taking. Non-systemically important non-deposit taking. That is how we term these NBFCs. And this criteria will be of 12 months for systemically important non-deposit taking and the deposit taking. Okay. Clear? Next, doubtful asset. Doubtful asset shall mean a term loan, means it can be any type of term loan, lease asset, hire purchase asset, or any other asset, which remains substandard. Now, if a substandard asset remains substandard for a period exceeding 18 months in case of NBFCs which are non-systemically important, non-deposit taking, then it would become doubtful asset. And this period of 18 months shall be considered as 12 months in case of systemically important non-deposit taking and deposit taking. So this will become doubtful when it is substandard. It remains substandard for a period exceeding 18 months for this non-systemically important non-deposit taking and 12 months For systemically important, no, deposit taking and deposit taking. Okay, clear? Clear on this? Yeah. Moving on to the last category. Last category means the category wherein the asset will become the worst. Loss asset means all the hopes of recovery of the payment and forget the principal are lost. The money will not be recovered. An asset which has been identified as loss asset by the NBFC or by its internal auditor or by its external auditor or by the bank during the inspection of that NBFC, to the extent it is not written off. And an asset which is adversely affected by the potential threat of non-recoverability due to various reasons. Okay, that will be considered to be loss asset. So we do not have any period criteria, etc. in case of loss asset. Okay. Now, when we started with this substandard category, we understood that a standard asset will become substandard when it remains NPA. When it remains NPA. Now, as a next step, we should also understand when would an asset be called as NPA. As I told you that these three categories are nothing but various forms of NPAs. Substandard is an NPA, doubtful is an NPA, and loss asset is also an NPA. But when would this categorization of NPA really start? When would this substandard be called as NPA, which will then become substandard, doubtful, or loss asset? So let's try to understand that. Yes. Non-performing asset shall mean an asset in respect of which interest has remained overdue for a period of 6 months or more. Please understand, this is a period which is overdue. For example, an NBFC has given a loan and the interest is required to be paid after 3 months. So the loan was given on 30th June and interest payment will start from 30th September. On 30th September, interest should have been paid. So when is this becoming due? On 30th September. So if this has not been paid for 3 months, we will not count that as a period. This period is overdue period. Means after 30th September, if it has taken 6 months or more and still this has not been paid, that is when it will become NPA. And this interest will not become NPA. This entire asset, this entire loan given will become NPA. Okay. So this overdue term you need to be careful about. An asset in respect of which interest has remained overdue for a period of 6 months or more. A term loan. Now specifically for term loan, what's the criteria? If a term loan has been given, inclusive of unpaid interest, when the installment is overdue for a period of 6 months or more, on which interest amount remained overdue for a period of 6 months or more. So for a term loan, it may happen that the interest has been paid, but the installment is overdue. So it is saying that the installment is also overdue, means the principal is also overdue, wherein interest is also overdue. Okay. Third, demand or call loan, which remained overdue for a period of 6 months or more from the date of demand or the call, or on which interest remained overdue. So either the principal or the interest. Fourth, a bill. So in case it's a bill which remains overdue for a period of 6 months or more. The interest in respect of a debt or income on receivables under the head other current assets in the nature of short-term loans and advances, which facility remained overdue for a period of 6 months or more. F, any dues on account of sale of assets or services rendered or reimbursement of expenses. which remained overdue for a period of 6 months or more. Okay, clear on this? Yeah. So when any of these facilities which are specified, they remain overdue for a period of 6 months or more, then such facilities, such assets will be termed as non-performing assets. Okay, clear on this? Moving on to next, lease rental or hire purchase installment, which has remained overdue for a period of 12 months or more. Similarly, if we look at point number H, it says in respect of loans, advances, other credit facilities, including bills purchased and discounted, the balance outstanding under the credit facilities, including interest accrued, made available to the same borrower beneficiary when any of the above credit facilities becomes NPA. Okay. So for an NPA, we understood 8 points. We understood 8 points. So for first 6 types of assets, means under 6 points, under the first 6 points, we looked at 6 types of assets. If in respect of those 6 types of assets, the interest or the payment remains overdue for 6 months or more, then the asset will be categorized as NPA, and which will then become substandard or doubtful or lost. Means on very same day it will not become substandard. It will take some time to become substandard because NPA has to stay NPA for at least 18 months to be called as substandard. So that means NPA will also cross a stage after which it will become substandard. So this is the distance which has to be cleared by this, and during this period an asset will be an NPA. Correct? And what is this distance? Distance is either 12 months or 18 months, depending on the type of NBFC it is. And for this NPA, as we discussed, there are 8 points which have been specified. In respect of those 8 points, in the first 6 points, we saw 6 types of assets for which interest or principal should not remain overdue for 6 months or more. And for 7th point, we looked at if it's lease rental or hire purchase installment, then it should not remain overdue for 12 months or more. So therein it changes. Next, 8th point, which is the most important part and very interesting part. Let's understand that. Say for example, a customer, NBFC, let's suppose, has a customer. Okay. NBFC has given a term loan to this customer. Okay. NBFC has also given, let's suppose, a demand loan to this customer. And let's suppose NBFC has also given a lease rental or hire purchase installment arrangement is also going on. Hire purchase installment arrangement is also going on. So 3 types of facilities have been advanced by the NBFC to this customer. Fine. This facility is performing well, means it's a performing asset. Demand loan is also performing well. There's been no delay. This is absolutely fine. So these 2 are standard assets. Okay. If you look at these 2 independently, these 2 are standard assets. But this term loan has become NPA. All right. This term loan has become NPA. Now this requirement point number H says the moment any of the facilities of a customer will become NPA, the remaining facilities of the customer, of the same customer, even if they are performing well, they would also be categorized as NPA. Because for an NPA, therefore, it means that the facility is not good or bad. It's the customer who is good or bad. Because if the customer has defaulted in this, then very soon he will default on this one, or he may default on this one also. And he may default on this one also. So that is what this regulation says. Yeah. So this tracking therefore has to be done customer by customer. And of course, in respect of customer by customer, if any of the facilities are different, still it will not matter. Okay. Clear on this? Clear on this aspect? This was a very important point in relation to NBFCs, and I'm sure that at your inter level, at your in your advanced accounting, you would have covered most of these provisions related to NBFCs, and these are very much similar to what you see in case of banks also. Yeah. Okay, so I have this query from Harshad. I think I missed it earlier. Harshad is saying, sir, for banks, it is CRR and SLR. I think you're talking about capital adequacy. For banks also, it is called as capital adequacy. It's called as capital adequacy norm. Same is the case for NBFCs. Sumit is asking, sir, the small finance banks and the payment banks are also NBFC. So the moment you call them banks, they are banks. They are not NBFCs. Okay, but for the banks, again, there are different regulations for different types of facilities which they offer. Okay, so we'll now move further, and again attached to this will be the provisioning requirements. Now, as per the requirements of RBI, or we can say as per the regulatory requirements, the moment an asset becomes NPA, or it shifts from this category to this category to this category to this, some provision is required to be made. Provision means a provision in respect of known recoverability of the amount towards that asset. Like you do in case of debtors. For debtors, companies create a provision for doubtful debts. Why? Because they think that some part of the money may not come, or maybe entire money may not come. Yeah. But in case of those debtors, in case of those companies, we wait till the time that loss is not assessed, that loss is not incurred before making the provision. But which is not the case over here. Here, the moment an asset will shift into a particular category, there are certain prescribed norms, there are certain prescribed percentages on the basis of which provision will have to be created by the NBFC, and which is mandatory. In case of a company, to create a provision for doubtful debts or not is discretionary. Discretionary means because it's judgmental. But here it's a rule. There's no judgment required. The moment you classify it as substandard, a certain percentage has to be provided. Doubtful, certain percentage has to be provided. No judgment involved in the percentage over here. Moreover, in respect of standard assets, even though they are performing well, they have been performing up to the mark, still, even for those assets, a provision is required to be made. And you may be thinking, but sir, these are good assets. There is absolutely no default and these have been performing well. Then why there is a need to create a provision for such type of assets? Now for this, the regulations say that an asset would not be good or bad at the beginning. Or in simple terms, we can say an asset would always be good at the beginning. No asset would have been bad at the beginning and then the money would have been advanced, isn't it? Money would be advanced to a customer on the basis of assumption, on the basis of an understanding that the money will be collectible. It's only after some period of time that this good asset becomes bad asset in any of these forms. That's why some part of these good assets should also be reserved, because all of these bad assets have emerged out of good assets only. Okay, clear? So now we will move on to the provisioning requirements as to what is the provisioning requirement for various types of assets. These provisioning requirements vary depending on the type of asset that we have. Now for a loss asset, I think it will be very easy for all of you to make out, and on the basis of your understanding also, it would be very simple thing to understand. Loss asset is the one wherein all the hopes of recovery are lost. There's no chance money will come. That's why, what's the requirement? 100% provision should be made. Provision in case of loss assets should be 100%. Entire amount should be provided for. Okay, clear? Now, moving on to doubtful assets. Doubtful assets, once again we can say, is one of the worst forms or a very bad form, but it's not the one which is as bad as loss assets. So that's why it's not completely 100% in all the scenarios for doubtful assets. Let's understand. It says 100% provision should be made to the extent to which advance is not covered by realizable value of the security to which applicable NBFC has a valid recourse. So let's suppose if against the advance which has been given by the NBFC to a customer, some security was held. Okay. So the provision for doubtful assets should be made after excluding the value of that security, because to that extent money will be realized by the NBFC by selling that security. Yeah, clear? Let's suppose a home loan has been given. Okay, home loan has been given to a customer. And what is the security? Property is the security. Now, in respect of this, the money which will not be realized will be to the extent of the value of the security. Because to the extent of the value of this property, money may be realized. So let's suppose if the loan given is 10 crore and the value of the property, let's suppose, is 6 crore, then what should be the amount which will not be recoverable at all? 4 crore. And 4 crore therefore should be provided 100%. So we can say, in case of secured, 100% after deducting realizable value of security. This may not be visible on the board, but don't worry about it. I'll come back to the full screen also. For the time being, everything is there on the presentation. In addition to A above, depending upon the period for which the asset has remained doubtful. Provision is required to be made of the secured portion. Now, in a way, in this category, what have we done? We have not created a provision of the secured portion. Basically, we have created a provision of only unsecured portion, isn't it? Yeah. So we can say under doubtful, there are two buckets. One is unsecured. Unsecured has been provided 100%. Second will be secured portion. Now, even for the secured portion, provision is required to be created, but that will be dependent on the time period. Means time period for which that asset has remained doubtful. So, if the asset has remained doubtful up to 1 year, then the provision will be 20%. If that has remained doubtful for more than 1 year, but up to 3 years, it's 30%. And if this is more than 3 years, it's 50%. And I'm just talking about all of these percentages for secured portion. So less than or equal to 1 year, this is 20%. Greater than 1 year, but less than equal to 3 years, 30%. Correct? Then more than 3 years, it's 50%. It's 50%. Okay, that's the basis which is required to be considered while creating a provision. Okay, next, substandard assets. Now this is simple. For substandard assets, a general provision of 10% should be made. It's simple. For loss assets, it's simple, 100%. For substandard, it's simple, 10%. For doubtful debts, there's a complication. So we'll have to just remember all of these points. So you'll have to just learn these percentages. And as we discussed, that even for a standard asset, a provision is required to be created. So let's understand the provisioning requirement for standard assets. For standard assets, a provision should be made in case it is systemically important non-deposit taking and deposit taking at the rate 40%. Okay, systemically important non-deposit taking and deposit taking 40%. And in case it's non-systemically important non-deposit taking, then it will be 0.25%. So here again we have two categories: systemically important non-deposit taking and deposit taking. It is 0.40%. And non-systemically important non-deposit taking, it is 0.25%. Okay, clear? Easy to understand? Yeah, easy to understand. Now, this was not something which we were actually supposed to do. And let me just give you the perspective why I'm making this statement. See, we are the auditors. We are not the part of the management, and we are not the part of the compliances team who will take care of these compliances. All of these compliances, all of these regulations, whose responsibility is this? It's the responsibility of the management. It's the responsibility of the entity. You remember, all of these are the responsibilities of whom? All of these are the responsibilities of the management. Yeah, all of these are the responsibilities of the management. Correct? Now, the role of the auditor is actually to audit whether all of these compliances which are required to be done have been taken care of or not. The role of the auditor is to check whether all of these things have been taken care of or not. Yeah. But because the auditor needs to ensure that whatever was required on the part of the management of an NBFC has been done by the management or not, auditor will also need to have an understanding, auditor will also needs to have a knowledge of all of these regulations. So that's why we went through all of these criteria one by one. We understood various regulations, we understood the meaning of NBFCs, we understood the various directions, we understood various types of NBFCs which are into place. We also understood the types of assets which it will have and the various provisioning criteria which the NBFCs are required to follow. Now, basis this, we will get on to the audit procedures as around all of these requirements that we have understood in relation to NBFCs so far. So first, what's the first procedure for the auditor? And in respect of audit, in the examination, please don't forget that irrespective of the nature of the entity, the basic audit process will always remain same. There could be certain peculiarities in case of any business, but as around audit, the overall audit approach will never change. The way audit is required to be done will not change. We may have a company which is manufacturing, or we may have an NBFC which has got nothing to do with the types of activities which manufacturing company will do, which is involved in the financial activities completely. For both of them, the audit process will remain same. And let's understand what's the audit process which they are required to follow. See, the companies are required, the auditors are required to follow, once again, the audit process into 4 stages: planning, execution, conclusion, and reporting. Now, as per the planning, auditor will be required to plan his audit procedures. Auditor will be required to do the risk assessment. Auditor will be required to come up with a detailed audit plan, basis which he will perform his audit procedures. And for this, it's very, very important on the part of the auditor to understand the nature of the business, to understand the company, to understand the industry in which it operates, to understand the economic environment in which the entity operates. Because without understanding of all of these things, the auditor will not be able to ascertain as to what all risks are attached to that entity. Auditor will not be able to ascertain what are the significant areas on which he needs to focus on. Correct? Remember, we discussed all of those points. Now, all of those points are no different in case of NBFCs. Here again, the auditor will have to understand the business of the entity. Auditor will get into a detailed understanding of the processes which the entity follows. Now, herein, some of the important things which the auditor would like to know, would like to understand. One, that is about whether the NBFC is registered or not. Maybe a company has been doing the business of NBFC without obtaining the registration, which will be a non-compliance. Number 2, as regards the understanding of the nature of the business, for which we also discussed, there's a test, 50-50 test, as around the financial assets which are comprising part of the total assets, as around the financial income which is comprising part of the gross income of the NBFC, and which should be greater than 50% so that it becomes an NBFC. This ascertainment will be done by the auditor by looking at the financial statements of the NBFC, or maybe the draft financial statements of the NBFC, and which will also be understood by going through some of the incorporation documents of that company, because an NBFC will definitely be a company. So all of these incorporation documents of the company will have to be understood by the auditor. He will have to have discussions with the management to understand the nature of the business this has been going on. And at this stage, because we are at the planning stage, so that's why auditor will not be able to get into the contracts, to get into various types of agreements which the entity would have executed, because all of these things will form part of the procedures of the auditor subsequently during the execution stage. Currently, the stage is the one wherein all of discussions have been taking place, various inquiries are getting performed. Yeah, and some of the preliminary documents about the entity or the company are being understood by the auditor, on the basis of which he will be able to make out the exact nature. Plus, on the basis of the size, on the basis of the directions which are prescribed, auditor should also make out whether this NBFCs is exempt from the registration requirement of RBI or not. If that is the case, then the auditor will have to look into the relevant requirements of that particular act. Maybe it's the stock exchanges which are really driven by the SEBI regulations. So the auditor will have to follow the SEBI regulations in respect of various compliances which the entity will have to fulfill, and accordingly he will be designing his audit procedures. Yeah. Another important aspect at this stage will be to chalk out a detailed plan in respect of various audit procedures as around significant activities, significant items of the financial statements of that particular NBFC. And for this purpose, auditor once again will do the risk assessment. Correct? Now, for the purposes of risk assessment, let's again go back to the understanding that we obtained. For the purposes of risk assessment, what is it that the auditor will do? Auditor will understand the detailed processes of the entity in relation to various areas. For example, advancement of loan. For example, receipt of any sort of monies which the NBFCs are doing. The overall process for income recognition. The overall process for accrual of expenses. All of these areas will help the auditor to understand what all risks are possible in relation to various processes of the NBFC. And as against this, the auditor will also be looking at the fraud risks. Please understand that it's all about monies which are involved in the business, and it's one of the areas which is significantly susceptible to fraud. Yeah, because of the involvement of the money at such a huge level. And that's why some of the areas which can be looked at from the perspective of fraud risk factors will have to be carefully evaluated by the auditor. Auditor will not be able to just look through and consider some of the items in a standard manner. It will require specific procedures on the part of the auditor, and this will also require thorough knowledge on the part of the auditor as around various requirements of this particular industry or this particular economic environment, because without the knowledge of this type of business, it will be very, very difficult for the auditor to get into a proper audit with proper audit plan. Secondly, as around all of these risk assessment, etc., which the auditor would have done, the next step for the auditor will be to understand, will be to ascertain what all controls are existing in the NBFC. Because management must have placed controls. And whose responsibility is this? Those charged with governance. NBFCs may also have an internal audit system similar to any other company. NBFCs may also have some external internal auditors who would be performing various areas from the perspective of assessment of internal controls as to whether they are operating effectively or not. Yeah, all of those areas similar to what we have discussed earlier will have to be evaluated by the auditor. Auditor would have to go through the walkthroughs of the processes in terms of the internal controls which would be existing. Auditor will also have to walk through all of these internal controls, whether those are related to financial reporting and in respect of their impact on the financial reporting, and how significantly those are impacting the financial statements of the NBFC, or if those are not related to the financial reporting, what's the relevance in the context of financial reporting? That is again one part auditor will have to make out. Further, in relation to this controls, the auditor will also be required to do some control testing. On the basis of the control testing, auditor would be able to make out whether the controls are operating effectively or not. Correct? Yeah. Now, during this process, auditor will be required to go through the contracts or the arrangements which the NBFC would be having with its customers. See, generally, one good thing which you'll find in case of NBFC is, and that also happens to be a bad thing, that unlike any other company, NBFC will have a huge volume of contracts. The volume of contracts, agreements which the NBFC will execute will be significant. Yeah, because the nature of the business it will have. But the good thing is that generally you will find that all of these contracts which are related to a particular type of asset or which are related to a particular type of facility will always be standard in nature. For example, if you go to a bank and you take a loan, okay, so the bank will get this loan agreement executed in its format. If you want to give your format for the execution of the loan agreement, then it will not be accepted. Yeah. So that is one area wherein the auditor will be able to go through the categories of the agreements which the NBFCs would have executed to get into the understanding of the types of transactions and the risks involved and whatever controls NBFC would have placed as to how those controls are operating or whether those controls are operating effectively or not. Clear? Yeah. Now moving further on to the registrations we have discussed. What's the next thing which the auditor will do? Now this planning and this risk assessment, etc., all of these things have been completed. Now the auditor will get into the execution wherein he will pick up the substantive testing. And let's understand what will this substantive testing include in the context of NBFC. For an NBFC, if we look at their financial statements, what will be the most important item in the financial statement? All of these loans advances. Correct? All of these loans advances which the NBFC would have given, they happen to be the most important item in the financial statements of the NBFC. Yes. And in terms of the P&L, yeah, in terms of the P&L of the NBFC, what will be the most important item? The revenue. And what is the revenue of the NBFC? The revenue of the NBFC is nothing but the interest income on all of those advances. These two happen to be the most important areas for an NBFC. So now the test check for all of these items will be done by getting into the contracts, by understanding the terms which have been executed, wherein the interest computations will be checked. And because there are going to be numerous contracts, there are going to be hundreds of customers which the NBFC will have, at least hundreds of customers. In fact, those will be thousands of customers, depending on the size of the NBFC. It cannot be checked on 100% basis. And today, currently, the way all of these NBFCs operate, they are very sophisticated in terms of the IT environment on which they operate. Yeah. So generally, for these types of audits, auditor will have to get into a detailed understanding of the IT environment of the NBFC. Lot of reports, lot of data will have to be pulled out by the auditor for the purposes of his checking. And as we have discussed, that auditor cannot check everything 100%. So that's why he will have to place reliance on the reports which are getting generated from the IT systems of the NBFC, and wherein IT specialists may also be required to be involved by the auditor, and through which he will be able to understand whether all of these reports which are getting generated and which have become the basis of payments or which have become the basis of collections, whether all of those reports are getting generated with the right output or not. Okay. Another area for an NBFC which can be considered to be important is about compliance of various rules and regulations. And this is something which we have talked about quite a lot. Compliance of rules and regulations is a very, very significant component for an NBFC. There are so many rules and regulations, whether it is about registration, whether it is about categorization into various categories, whether it is about categorization on the basis of kind of activity they do, whether it is about on the basis of size which they will have, and whether it is in respect of the assets categories which it will have, whether it is in respect of the provisioning requirements which the NBFCs will have to do, whether it is in respect of the income recognition criteria which the NBFC will have to fulfill. So all of these compliances are not easy to monitor. And that's why generally you will see that NBFCs will have an internal compliance team. Internal compliance team. I'm not talking about the accounting requirements only, about various compliances, because all of these compliances may have a strong impact on the financial reporting of the NBFCs. And that is where all of those compliances which have been taken care of by the NBFCs will also have to be reviewed by the auditor. This is again a very important procedure on the part of the auditor. It's not that the auditor will become the compliance officer, no. But whether the compliance officer or this term which I have been using is in respect of the compliances of the NBFC, whoever is taking care of all of those compliances, whether those compliances are really in requirements, are in line with the requirements of the various provisions, whether those have been taken care of or not, is once again reviewed by the auditor. And for which he will require access to the data, he will require access to various reports which would have been submitted to the regulatory authorities and which would have been sort of could be in the form of communications with various regulatory authorities. And for NBFCs, a lot of communications keep taking place between the regulatory authorities and the NBFC. So all of those communications are important for the purposes of understanding of the auditor. And as I have told you that in this respect, the knowledge as around various legal provisions is very, very crucial. When it comes to the prudential norms, like for example, categorization of an asset as NPA, then not recording income on those NPAs, or reversal of the already recorded income on those NPAs which has not been received, is all very important. And for this purpose, once again, some of the audit procedures which the auditor would employ would be about the understanding of the terms and conditions in relation to the facility which has been advanced. Then to check again on sample basis about various collections which the NBFCs have been getting. All of these collections can be checked through the statements of those customers as to whether those customers have been making the payments of interest or principal or time or not. Many a times, this is very common, many a times it is found that even though an asset should have been classified as NPA, but that has not been done. So all of such instances are required to be properly understood by the auditor. See, for an NBFC, what is their overall strength which is reflected in the financial statements? The assets which they have got. Yeah. It's like any other company. Every company has got assets, which is the strength. And out of these assets, if the assets are not good, will that really reflect in a nice manner on the part of the NBFC? Not at all. So that's why there could be an inclination on the part of the management of an NBFC to not show the NPAs, or to show the NPAs not at the right level but at a reduced level. And that is again a very, very important area which needs to be considered by the auditor. And once again, for this aspect, as we have discussed, that it's not possible for the auditor to check each and everything. Herein, one important aspect which the auditor will have to consider will be to get into the understanding of the control environment. Because if the NBFC will have a strong internal control environment, that would give a big relief to the auditor in terms of various procedures that he requires. Okay, yeah, clear on this? All right. So now with this, we have discussed certain procedures around various areas of NBFC. Now we can move on to certain frauds which could be seen in case of NBFCs, and around which some of the procedures which the auditor should plan. I would say another very important area in relation to NBFCs. In order to have uniformity in reporting, frauds have been classified as under, based mainly on the provisions of Indian Penal Code. See, unlike other companies, NBFCs who are involved in dealing with money, as we understand, these are all financial activities. So that's why frauds are commonly found. And you will be thinking, sir, frauds? Yes, frauds are commonly found. It's common to find frauds in case of financial entities like NBFCs. And that's where a reporting mechanism has been set up in respect of various types of frauds. They will be categorized into. So what is the first type? Wherein there is misappropriation and criminal breach of trust. Second, fraudulent encashment through forged instruments, manipulation of books of accounts, or through fictitious assets and conversion of property. Unauthorized credit facilities extended for reward or for illegal gratification. Negligence and cash shortages. Cheating and forgery. Irregularities in foreign exchange transactions. Any other type of fraud which will not cover under these heads. So there are 6 heads which are specific, and any other type will go to others, wherein we'll have to specify as to what's the nature of that fraud. Okay, depending on the type of the fraud it will be categorized into these categories, and then it is reported to the relevant authority. So we are not required to get into those authorities as to what are those reporting requirements. No, that is not an area for us to look into. Further, cases of negligence and cash shortages and irregularities in foreign exchange transactions, which are covered under D and F above. Yeah. If you go back, you will see category D, negligence and cash shortages. If you look at category F, irregularities in foreign exchange transactions. These are types of frauds. These are reported as fraud if the intention to cheat or defraud is suspected or proved. Okay. So unlike other categories, these will be reported as fraud if there is an intention to cheat or defraud is suspected or proved, otherwise not. However, the following cases where the fraudulent intention is not suspected or proved, at the time of detection itself, they will be treated as fraud and reported accordingly. Let's understand what are those. Cash shortages of more than 10,000 rupees. So those, even if those are not suspected or proved, at the time of detecting such fraud, those will be reported as fraud. And cases of cash shortages more than 5,000, if these are detected by the management, auditor, inspecting officer. Inspecting officer means any relevant authority has sent the inspecting officer to inspect about these cases or to inspect about any matter related to NBFC, and he found such cash shortage of more than 5,000. And these were not reported on the occurrence by the person who was handling cash. So there was a cash shortage of 5,000 and the person who was handling cash, he did not report. So when both these criteria are fulfilled, then these will be reported as fraud at the time of only detection, even if those are not proved. Okay. But the other one will have to wait till the time those are proved. Yeah. NBFCs having overseas branches or offices, means outside India, should report all frauds perpetrated at such branch or office to the Reserve Bank as per the prescribed format and procedures. Okay, so that means in respect of those foreign branches, foreign offices, all the frauds are required to be reported to Reserve Bank. All the frauds. Yeah, so these are all reporting requirements in relation to frauds. And you need to just look through these categories. You don't need to get into too much technicality or too much detail around all of these frauds or how all of these reporting mechanism will work. Yeah. So only the categorization between these two. But I would say in this NBFC, this particular topic should be considered to be very, very important by all of you. Yeah. Because under any area, whenever it comes to fraud, yeah, that is always considered to be very important. So whether you look at it from examination perspective or otherwise, this I would say is or should become an important area for consideration. All right. Yeah. So with this, I think we have partly covered the requirements of NBFCs, and we are still left with various requirements of NBFCs and the audit procedures around it. But considering the time, we'll just stop our discussion now, and the remaining part will cover in the next session. But one thing is for sure, that because this is a topic which will also have some interlinkages, so that's why I would request all of you to come prepared. So that means after the revision in the next session. Otherwise, you may just start feeling disconnected on some of the provisions. Okay, and it will be good for you to absorb all of these things in a better manner if you revise that. All right. Yeah. And in the next session, we'll also pick up some examples based on this. And that will also be coming in your mind, sir, what sort of questions we should expect on this. So we'll pick up some examples as around all of these things. Thanks, Chavi, for this. Ambika is asking, sir, there's no requirement of materiality. No, of course. See, materiality is permissive. That applies everywhere. And in case of NBFCs also, materiality will be the consideration. Okay. So thanks to all of you. Thanks once again for your time and for your wonderful participation. So we'll meet next, and your homework is revision of whatever we have covered today. Thanks so much.